Excellent. What a fantastic turnout. Thank you so much for making the time and coming over to listen to this talk. This is always a difficult session, isn't it? Right after lunch. Let me see how many of you I'll manage to keep awake by the end of it. So welcome. My name is Pradeep. I work for Finova. And I'm very excited today to be talking to you about a topic that I am very enthusiastic about. The role of intelligent and dynamic pricing in the home finance market. And today we will talk about it more from the equity release segment perspective. Now, before I do that, let me say a little bit more about my background. As I say, I work for Finova, which is a technology provider, and I'll talk a little bit more about what Finova does in a second. So I'm myself qualified as an engineer. I had a bit of a career in venture capital investing. I invested in a bunch of fintech companies and all sorts of exciting startups, and which brought me to mortgages. And looking at the mortgage market and in its great variety around the world, and in many places in the world, it's done in a much more digitized manner. The experience is much better for consumers and brokers. And I launched a startup called Burrow, which was intended at bringing digitalization to the mortgage market. Burrow was then acquired by Finova back in 2018, and then I came to work at Finova. And I've had a few different roles there. I've mainly managed innovation, working on a number of different emerging propositions at Finova. Being a technology provider, it gives me a lot of opportunity to play around with technology, which I love. And I get involved in a lot of various trends, what a consumer's looking for, what a lender's looking for, and so on, which is quite fun. So before I go on to talk a little bit more about Finova, it'd be great to get a little bit of a feel for who's in the room. Do we have any lenders in the room today? Quite a few. Perfect. Brokers? Fantastic. Technology providers? That's a good mix. Fantastic. That's great. Okay, so Finova, a technology company that was established back in the late 90s, so been in the business for about more than 25 years. We are the trusted partner for a lot of financial institutions. About 60 lenders use our core banking platforms for their fundamental originations and servicing of mortgage loans, equity release loans, personal loans, etc. We have about 3,000 brokers using another platform that we provide. It's a CRM fundamentally, and associated services for brokers. In total, we have about 200 financial institutions that are using a range of our technology solutions, including something that we call Connect, which is about industry connectivity. We have originated more than 400 billion through our platforms, and currently more than 30 billion is under management through our platforms, primarily our servicing systems. So our purpose at Finova is to modernize and open up access to mortgages, lending, and savings products. Now, we have a number of lenders in the room. You guys will recognize that platforms, software systems across the market, whether it's mortgages or lifetime, there is quite a lot of legacy systems, to put it mildly, right? There's a lot of rigidity in the systems and so on. So one of our missions is to bring modernization, digital transformation to such platforms and allow them to be much more agile and competitive in modern environments, and to open up access, to democratize the product information, consumer data, criteria data, and all of that, which is, again, held in closed systems. And I'll go on to talk a little bit about what the benefits of doing something like that would mean for pricing in today's context. So we are chosen by a wide range of financial institutions. We provide these systems to several banks, several building societies, equity release providers, and specialist lenders. There's a pretty wide market coverage. It's a very diversified business. And we supply to 40% of the top 50 lenders in the UK. So in more recent years, we have focused on the equity release lifetime sector, and we've been making some waves in this sector. And as you can see on the top right-hand corner there, we supply Aviva, Legal & General, LV, More to Life, all of the top providers, and many of them are in the conference here with us today. So which puts us in a pretty privileged position, and I'm actually quite proud to say that we are the technology partner of choice to 70% of the equity release lenders in the UK market, and that's by gross lending volume. So when I say chosen technology partner, it is the fundamental technology platform using which they do their originations, and manage all of their product data, manage all of their business rules, product rules, the broker application platforms, all of that is provided by Finova. Okay, so that's enough of a background on Finova itself. Let me move on to the topic of interest today, which is more around dynamic and intelligent pricing. So a few months ago, probably about a year ago, a few of our customers started asking us more about a lot more flexibility in their pricing, a lot more dynamism in their pricing, and which led us to recognize that as a need. And we went out there and we did a lot of research. We looked at the market trends, we interviewed a whole lot of lenders, we talked to a few brokers, and we learned a lot about the patterns and trends that are shaping at least this part of the market in terms of product management and pricing management. So to begin with, I'd like to tell you a little bit of the highlights of what we learned by talking to these lenders and brokers. The first thing is that following the mini budget in 2022, over 40% of mortgages had to be quickly withdrawn from the market. That's more of a statistic on the mortgage market, and it wasn't too different to what we saw in the lifetime sector as well. A lot of the lenders had to pull their products, many had to suspend lending, some of them even went to the brink of collapse. Now, that might have been a one-off incident driving that, but we've also seen things like economic factors like inflation, or whether it's war or the base rate ticking up. We have seen quite a lot of turmoil and flux in the market last year. And what we did notice, and I'm sure you've all noticed this, is that lenders really need a way of making changes to their products and their pricing much more quickly than they can do today. The problem, however, is that there is a whole lot of rigidity. Some of it is to do with the systems and the software. Some of it is to do with people and processes. Some of it is to do with the entrenched ways in which distribution to the market and to brokers works. So there is a lot of challenges to solve in order to bring about change to this paradigm. So as I was saying, it currently takes several days, sometimes even several weeks, to make even something as simple as a rate change across an existing product catalog. So if you have to make greater changes, whether it's to product features or any other deeper changes, it's even longer. So one of the things that at least we as Finova can focus on is the software rigidity and constraints. And what happens is that the lenders at least will be familiar, actually even brokers get a lot of the product data through spreadsheets, right? So lenders manage a lot of the product data on large spreadsheets. And actually, even though that may look clunky, it's actually a good way of managing products, a lot of product complexity. But when it comes to then keying that data into product management systems, the software, and this is not just a Finova problem, many of our competitor softwares also have the same issue. Many homegrown lender systems also have the same issue, where every product is having to be entered as a unique product in terms of, as in every variant of the product needs to be entered as a unique variant, which quickly leads to hundreds of products accumulating in a lender catalog, even though their core catalog may only be, a dozen or so products. So every time you introduce a new little variation to a product, you have to clone the whole product catalog, and that just leads to, enormous complexity growth. And that has an impact on the performance of the whole system, slower response times, which brokers don't like. The entry and management of the product changes takes a lot of time and so on. So it has a lot of knock-on effects. Now that becomes an even bigger problem when you look at the next trend that we noticed, which is that actually lenders want to go in the opposite direction. They want to actually introduce even more variety and variation in their product catalogs, while the systems and other constraints are pulling in the other direction. Now, lenders are having to do this because they need to be, in some cases, a lot more price competitive. In some cases, they need to be meeting the very specific tailored needs of their customers. Sometimes it's just about greater competition in the market and fight for market share and so on. So today, there is about 8 times more products in the market than there were 5 years ago. So there is a clear trend for greater variety of types of product. And in the equity release sector, that could be things like greater flexibility of repayment options. It could be how do you protect equity. It could be bringing over some of the incentives that we've seen in the mortgage market, like cashback or free vals and things like that, which many lenders are already doing, but not quite with the flexibility that they would like. The other key trend that we did notice is that there is significant appetite amongst lenders to bring in pricing based on specific criteria and other risk factors. As an example, medical data. Again, many lenders are already doing this sort of thing. And in fact, amongst our lenders, our customer lenders, we're seeing the introduction of pricing on property type, postcode data, EPC ratings, and so on. And that is just the tip of the iceberg. Now, there is a lot more data available upon which pricing can be based. And once again, that is better for greater quality of underwriting. Again, it gives rise to more tailored products. So there are a number of benefits to being able to do that. And as I mentioned, today, risk-based pricing is very rudimentary, while the trend is very much towards greater capability of being able to do that. So to summarize the lender challenges, we've seen economic uncertainty. There is a great amount of competition, as I mentioned, pressure on margins. There's a need for innovation, need to better manage risk. And there's also consumer duty and regulation pressures that require greater flexibility of products management. We won't get into too much detail on that today. Okay, so we took all of that learnings that we got from the research that we did and thought about, well, what is it that a solution to all of these issues that we have just understood? What does it need to look like? And essentially, it just needs to allow lenders to have more pricing sophistication without increasing complexity. It needs to improve performance in terms of operations as well as innovation, and it needs to improve the agility to be able to make changes faster and at less cost. So just to get into that a little bit more, what it means is that you need to have a system that enables consistent pricing to be delivered across the system, across the entire market, end to end. So end to end, as in you would have to have the consistent pricing flowing all the way from the product management catalog systems, which are at the back end, all the way through to the front end, which is the sourcing systems where brokers are getting all of their product and pricing information from. It's quite a long distribution chain that needs to have consistent pricing information. There needs to be an ease of inflow of new data, and that needs to be integrated smoothly across criteria, product data, as well as pricing data. And the end-to-end process of building products, pricing them, testing them, distributing them, and making changes to them while they're live needs to get easier and more flexible. And finally, there needs to be a dynamic element of being able to make away with this current paradigm of rigid catalog management systems and bring in something that is more flexible and modular. And that exactly, folks, is what we are actually building at Finova at the moment. We have developed a system that we are calling Optimo. So may I introduce you to the newest shiny baby of Finova. What it is an efficient product catalog management system that will allow lenders to do intelligent and dynamic pricing. So it allows the dynamic product and pricing management that lenders will then be able to reduce the catalogs by using the system while not reducing the variety and variation in products. It will help lenders to reduce the cycle time in making changes by up to 80%. So that is from several weeks down to maybe a couple of days, And the hope is that it will reduce the cycle time even further to maybe even be able to do live price changes one day. It will allow lenders to do easy introduction of new data items, democratize that whole access to effectively more and more data available out there. I'll touch upon that a bit more. And as a cherry on top, it allows self-serve, which is again something that lenders love, which it allows them to be able to self-manage a lot of the change processes and reduces vendor reliance to a large degree. So in summary, it would increase responsiveness, increase the ability to differentiate in the market at reduced complexity and reduced cost. So let me touch upon a little bit on the personas that we learned within the lender teams in terms of how and what benefit does Optimo bring to the lender teams. And first of all, it is the loan products team. So we were talking to a few lenders, and they were saying that our loan product development teams generally have fantastic ideas about all sorts of new products they want to launch into the market. And it's kind of like an architect's diagram of what a beautiful house is going to look like. And by the time that has been put through the operation systems and the IT systems, it comes out looking like an old hut, which is what they can actually execute. So that is the frustration that product teams have. They're doing all the research to know where all the niche opportunities are in the market, and they go out and build fantastic products, concept products, obviously, but they're not able to execute that in the market. So they love this idea. The risk and compliance teams, risk in particular, this is a product that would allow you to price more accurately, and therefore it lifts the quality of underwriting, it lifts the quality of the loan book, reduces the delinquency opportunity and so on. So again, loved by the risk teams. Operations teams love it because it reduces the time and effort taken to make changes, which is faster changes into the market. So that's a tick there. And the sales and marketing teams, they are also quite interested in marketing the variety, the ability to say yes to more people out in the market. So having more tailored products allows the sales and marketing team, the BDMs, to be a lot more effective when they are presenting the lender and the products to brokers. And finally, of course, the exec team, the tick boxes for them are reducing cost, increasing innovation, and therefore hopefully market share. Okay, now let me touch upon a little bit more in depth on what the product capability itself is. How does it do these things that I'm talking about? So the first thing is to do with collapsing the product catalog. Earlier I talked about having hundreds of products because of the variations having to be coded in individually. Now, the way this system works is, the easiest way to think about it is think of it as Excel in the cloud. It's all managed with tables and formulae, which makes it a lot easier to build the products dynamically. So you don't have to have these hundreds of products anymore. That paradigm goes away. You have a few, maybe a dozen or so core products or product categories, and then you build all the dynamic features of those products dynamically as they are requested. It delivers agile pricing. So how does it do that? How does it speed up the time to market? It has simple capabilities like being able to upload those spreadsheets that lenders manage all of their product data on, so that if you wanted to make a simple rate change across the entire catalog, you're no longer making individual changes. You simply upload the entire the catalog of rate changes, and instantly it makes a change to all of the hundreds of products that you might have already keyed in. It brings in data-driven pricing. So again, imagine in the tables where you can have things like I mentioned, for example, property type earlier. So if you want to base your price on property type, you would just simply have a table that says, what is the property type, bungalow, terraced, detached, whatever it may be, and you have a rating factor against it. You have a base rate for that product or product category, and then depending on which of those property types it may be, you increment or decrement the price by a certain number of basis points. So that it allows that simple flexibility there for the price to be read depending on the application data that's being fed in. Now, if you take that level is what I think of risk-based pricing is going to be coming into the market. Many lenders currently already do it, as I mentioned. However, it is still quite clunky. It doesn't quite give you the flexibility that you need, but somehow they're managing to do it. This will be an improved situation once Optimo comes into the market. We will be launching later this summer. And the future, the utopian view is fully personalized pricing. That's where we ultimately want to take it, and we're building the basic foundations for that right now. So fully personalized pricing, what does that mean? It means that a broker or a consumer could enter all of their data right at the front end of whether it is sourcing or the D2C front end, if that ever happens in this market. Don't know, but at least for now it's on the broker front ends, where all the data is captured. The idea is that ultimately you would be able to plug into data sources and not necessarily have to collect this data from the agents or the consumers or whatever. So you can plug into the likes of Price Hubble, Home Track. There's many sources of data. Once the data is all come in, you have the entire application data about the applicant as well as the asset that you're pricing on, gets fed into the Optimo backend, and a specific product, a tailored price, is then returned all the way to the broker front end or the consumer front end. That's our utopian view for the future, and actually we don't think that's all that far away. Maybe 3 years. And finally, all of this is wrapped inside a system of test-driven design. And all that means is that while you're making the changes, there is a comprehensive testing capability that allows lenders to be able to test all the changes that they are making end to end, so that it's not a big bang kind of approach, waterfall approach, where you release a change and then you find out what kind of impact it has on many other parts of your system. So it is test-driven design, and as I mentioned earlier, it is self-serve capabilities as well. It's a simple, usable UI that lenders can log into themselves, build all of the products, make changes whenever necessary, and push live. So that's how it's all done. Let me touch upon a little bit more on the data hub concept. So we did touch upon it a bit earlier. And the equity release market, obviously a lot more dependent on pricing factors that are about the asset, the property, and less so about the applicants, because it's obviously not based on income, etc. But that might be a case in hybrid products or REO products and so on. So you do need data flowing in about both the applicant as well as the property. So property data, postcode, etc., location data, there's things like flood risk, crime rates, etc., that might have an impact on pricing. This essentially, it makes testing new niche products much easier as well. We were talking to some of the mortgage lenders actually, and it's equally relevant for them. There are many postcodes in which they currently don't lend for various reasons. Actuarial tables saying to them that it's too risky. However, if they have the ability to alter the price at a different price, they may very well be willing to test those niche markets. And because the price has collapsed of testing these new niches, it becomes a lot easier for them to make those offerings and easily pull back in case it doesn't work for whatever reason. Medical history, credit history data, less relevant for this market segment, I think, but we're making an offering for the mortgage market as well. But employment types, etc., can be drawn down from the credit bureaus, and there's ONS data. So all of this can feed neatly into the product building and the pricing, and that will be an integrated part of the Optimo proposition. So speaking briefly about the stakeholder centricity, there's obviously many participants in this market. You have the consumer, you have the broker, you have the lender, you have the funder. Now, how does this actually help or pose a risk potentially to each of these participants? Now, to the consumer, as I've mentioned, the hope is that it would be a more inclusive market when you're able to offer products to many of the niches that may currently not be able to get a mortgage or a lifetime loan. Potentially more competitive rates, right? So because you're able to get a more granular understanding of the participant, of the applicant and the property, then the pricing should actually be keener and drive better outcomes for customers. The brokers are always interested, I would hope, in better customer outcomes. more tailored products for customers and what is a better, suits their situation better. So that is clearly something that could come out of this. What we might lose potentially is some level of transparency and comparability of pricing, because it changes. In a future evolution of this product, what it does change is you would have to go quite deep into the application process itself before you got the final actual product and the actual pricing for that particular customer, rather than having a very simple source as the way it is today with a few bits of data, and then you choose the lender and go right down the path with that particular lender. The difference here would be that you would need all that data, and you would need to go all the way through with all the lenders. So then you have perfect comparability of product. As for lenders, we've talked a lot about the benefits to lenders. As for funders, again, they're very interested in ensuring that the quality of their investment in terms of the credit risk, et cetera, is kept high. So there is value in it for funders as well. And finally, I'd just like to touch upon what is the business model for Optimo. So Optimo will be offered out to the market as a independent, standalone software as a service model. It is vendor maintained, and it's a SaaS model in the sense that all of the upgrades and improvements that would be made to the system would belong to our innovation division. So we would be coming up with all of the improvements that product needs to have. Think of like a Slack or Teams or whatever, and those improvements will continuously flow into the product rather than having to choose or take any upgrades. It will work on a subscription model, and it's all cloud-based, so completely managed and hosted solution. And the most important thing, I think, is that it is a modular solution in the sense that if you wanted to use Optimo, you do not have to use any other Finova product. You could use any other origination platform, a home-built origination platform, and it would still be able to be integrated with that origination platform through the API. So it's an API-first technology. There's an API gateway stack in there through which the origination platform will communicate with Optimo sitting in the cloud. So I'd like to leave you with the key message being, there is a great need for faster changes in the market. There is a need for greater flexibility in product catalog management and pricing changes. And there is a great need for bringing in more data elements to make pricing keener and products more customized and tailored to changing customer requirements. And that should be of benefit to all the stakeholders in the market, consumers, brokers, lenders, and funders. Thank you very much. I have no idea how much. Oh my God, look at that. Exactly on time. Did not expect that. I usually go over. I suppose we might have a few minutes in case anyone had any questions. Happy to take them.
Hi there, Charles Mungrue, Just Group. As you move into dynamic pricing and you end up moving the price for individual customers, I imagine that it therefore moves the comparable overall cost for the customer and very specifically the other lenders that the products will be comparable against. So I suppose the question is, as you move those dynamics and therefore you move on to a different sort of price elasticity curve, how do you account for the anticipated volume and therefore the product mix?
Such a great question. I mean, it's really at the heart of, I would say, the initial hurdles that this whole shift in paradigm of how it's not just about changing the software in which you manage your product catalog. Actually, you'll have to sync it with the entire distribution ecosystem, and you'd have to have better education for brokers so that they understand a whole new different way of doing business. So I think there is a lot to be overcome there. I think there's a lot of the first initial steps have already been made. I think if brokers are going to be more interested in better customer outcomes, I think that's what we need to sell them on in order to be able to invest the time in putting in all of the data that's going to get them that final price. So that's one of the hurdles. I think they're doing that already to some extent, which will make progress in that direction. But ultimately, I think your second part of your question is more around how does the lender manage the volumes, And yeah, we're very aware that lenders have very specific shape of business that they want to receive. And in fact, Optimo is a great benefit for that as well, because you think about ultimately this becomes algorithmic pricing, right? So I can actually set rules in the system to say, if I've had X amount of business in such and such segment, then increase the price or decrease the price. It's like a throttle to allow less or more business. So you can actually much more closely model the inflow of business to your ideal operating model. Hopefully that makes sense. Yeah. Anyone else?
Do you not think there's Hi, Peter Huckabee, Lifetime Equity Release. Do you not think there's a risk of developing a bit of a two-tier system? Because I know obviously one outcome could be that one client might get a better price, but lots of other clients could end up on much worse prices or much worse deals. And as you said, there's a bit of a lack of transparency in the pricing, and with Consumer Duty coming along, I could see this potentially is a bit challenging to introduce. And from what you've just said from a broker's perspective, it doesn't sound fantastic in terms of not being able to get a quick and accurate picture of exactly what we can get for a client. It would really involve a broker having to completely change their model in order to deal with this.
100%. I mean, look, I completely understand the question, and that's something that we are asking ourselves every day about. You know, we are one player in a large ecosystem of technology providers and data providers, et cetera, that all sort of needs to come together to make the problem that you're talking about, to overcome that. And to some degree, you have to have behavior change, right? If this was happening in the mortgage market, we would actually be a lot more reticent about it, because changing the behavior of 10,000 brokers is going to be a lot harder than hopefully a smaller number of equity release brokers, because we're in the early stages of this industry. And as it evolves, if we can, you're shaking your head there, I completely understand what you're saying. Of course, brokers are like, well, I just want to do a quick search, 3 bits of information, tell me the products. That's the way the whole industry works right now, and mortgages works like that. And that actually causes a huge problem in how much innovation you can bring to that market. If you think about it, one of the biggest problems that mortgage brokers have is certainty of lending. Why they have that problem is because they just want to enter tiny bits of data in the beginning, get a whole lot of products, and then they go through the whole, the DIP process or whatever it may be, and ultimately find out in many cases they're not going to get the lending because the criteria is so complex, and you have to hold it in your head rather than have it electronically delivered to you. This shifts that whole paradigm. If you're willing to make that little bit more effort at the front end, the whole journey becomes a lot cleaner, both for the broker as well as the consumer. I know that might be a hard sell right now, but our position is, this is going to be, it's worth a try. It's worth a try. And the lenders are saying they want it, and as I say, we're going live with one of our first customers in the summer. We have spoken to brokers, and they do have the opinion that you just gave, agreed. There is also, positive interest, and if I can get certainty of lending up front, that also has value. So no perfect answers. Sorry, last question. I'm being asked to wind up. So,
just on that note, is it then something that you should focus towards the sourcing systems, so that if we've got the availability to put in postcode, type of property, some of these individual features that you talk about, and then the lenders that have subscribed into that, we can see that pricing come through, or alternatively be a cascade system. So if the sourcing system tells us what's the best price we can get in the worst scenario, and then once the valuer has gone out or once the lender's looked at the criteria, it then cascades down to a better rate.
Yeah.
Is that the fairest way of doing that?
Well, 100%. I think we considered the second option that you just gave, but I don't think that works, because then, again, you have a problem with comparability of product, and then you don't want it to go either up or down as you go down the line.
Improve, then surely it's not.
But then you don't know how much it's going to improve as you put in the more data with different lenders. You would only go down. So what you said first is actually the right answer.
Yeah.
So put the right data in sourcing, And we are working with air sourcing, we are working with IRES to have this integration in on day one, and they are already collecting data like postcode, EPC, etc. So you put the data in there, it consults the optimal product at the back end, comes back with the right product and price. So that's how we turn it. Thank you guys, great questions. Thank you so much for your engagement. Thanks a lot.